just when we thought the Calgary real estate market might start to balance out, in comes the federal government with new mortgage rule changes that will shake things up. Now, whether you're a buyer, seller, or you're not even currently in the market, this is going to affect you. Let's talk about why.
This really is about fairness for every generation. It's about making that first home more available for young Canadians, for first-time home buyers.
Instead of waiting for the Bank of Canada to gradually lower interest rates, the Liberal government has stepped in with new policies that are sure to impact the housing market here in Calgary. So, what are those changes and how are they going to affect us? Let's start with what's changed. You might remember that as of August 1st, the government allowed first-time homebuyers to stretch their mortgages over 30 years, but only if they were buying a new build property. Well, now they have extended that 30-year amortization option to include any type of residential property for first-time homebuyers. But that's not all. The government is also raising the limit on insured mortgages from $1 million to $1.5 million. This means more people could qualify for a mortgage with less than 20% down. Currently, you can put 5% down for homes up to $500,000 and 10% on the portion above that up to $1 million. We don't yet know if the 10% rule will apply all the way up to $1.5 million, but it's a big shift nonetheless. So why now? Well, beyond the current political drama, like the NDP ripping up their agreement with the Liberal government, which could trigger an election at any moment, it's always said to be for the benefit of the people, right? But is it really? You might think these changes are great for helping younger Canadians get into the market, especially since so many feel home ownership is out of reach. It will allow for many first-time buyers to either expand what they can afford or make owning a home actually a reality, but there are some potential downsides that aren't being discussed. Let's look at the 30-year mortgage. Sure, in the US, 30-year mortgages are pretty common, making monthly payments lower, which sounds appealing, but remember, the longer the mortgage term, the more interest you pay over time. For instance, let's look at a mortgage of $600,000 with an interest rate of 4.5%. Now, if you were paying the same interest rate for the entirety of the loan, the difference in monthly payments between a 25-year and a 30-year mortgage is about $50 per 100,000. So in this case, about $300 a month. But the total interest paid over the loan's life is significantly higher. At 25 years, you're paying $400,498 in interest alone, but for the 30-year mortgage, you're almost $100,000 more at $494,440. And this doesn't even take into account that the interest rates on a 30-year mortgage are actually slightly higher as well, so it could be over $100,000 difference. You pay less now, but much more later. Now, some people think these changes are a great thing, making purchasing a home more affordable for first-time home buyers. And you can, of course, always make extra payments that are direct to principal that will shorten the loan length, and you can pull those back if needed. However, there is an unintended side effect, and that's that home prices could actually rise even more. With inflation now hitting the Bank of Canada's 2% target, we could see deeper rate cuts than originally planned. The bank was already lowering interest rates, so this shift could accelerate these price increases even more. Here in Calgary, we've been somewhat shielded from the full impact of rate hikes due to the high level of interprovincial migration and immigration. It looked like we were moving towards more balanced market conditions, but will this decision steer us back to that stronger seller's market? As for raising the insured mortgage cap to $1.5 million, it might have a lesser impact in Calgary, where the benchmark price is still under $1 million. However, we could see more activity and in turn rising prices in the higher end segments like acreages outside the city, which are already quite expensive. And this isn't the first time Canada has tinkered with mortgage rules. We had 30-year mortgages until 2012, and before that even 35 and 40-year mortgage options were available.
The government is tightening mortgage rules, basically reversing its own decision to loosen things back in 2006.
Now, it will mean that some people will not buy into the market.
So why are we revisiting this now? Governments decided in the past that longer loans weren't a good idea, but now the landscape seems to be changing. These changes are set to take effect on December 15th, and while we don't yet have all the details, one thing is clear: they won't solve the housing crisis. That's a supply issue. And allowing Canadians to take on more debt doesn't exactly address the root of the problem. If you've got any questions about how these mortgage changes could affect your specific real estate goals, I'm happy to answer them. You can book a call with me in the link below, and I'll see you soon.